Right now, the market sits near an all-time high. Portfolios are green. The headlines belong to artificial intelligence, to record earnings, to fresh records. Everything feels calm, and that is precisely the problem, because there is a pattern in the stock market, one that repeats every 4 years, like clockwork, and it is the single most reliable source of large drawdowns in the entire cycle. Wall Street knows it. The data is public. It has held for 80 years. And almost no one is warning about it now, because at this moment, there is nothing frightening on the screen. What follows is that pattern. Why 2026 is loaded differently than an ordinary version of it. And the part the doom stories always leave out, the part that actually decides what happens to an investor's money. It sounds like superstition until the numbers arrive. The American market moves in a 4-year rhythm tied to the presidential term. Year 1, post-election. Year 2, the midterm year. Year 3, pre-election. Year 4, the election year itself. And of those 4, one is consistently the ugliest. Not the election year, the midterm year. Year 2, the record is plain. Going back to 1945, the S&P 500 has averaged a gain of roughly 3.8% in midterm election years. In the other 3 years of the cycle, closer to 10.9%. Same market, same companies. Yet that single year in 4 delivers about a third of the return. And the average is not even the dangerous part. The danger lives in the intra-year drawdown, the peak-to-trough fall at the worst point of the year. In an ordinary cycle year, that decline runs near 12%. In midterm years, it swells to roughly 18 to 19%. 19% is the doorstep of a bear market. It is the kind of move that pushes an ordinary person to open the app, see the number, and do something they will regret. This is not one cherry-picked data set. Stratagas examined 16 midterm cycles from 1962 to 2022 and found the same thing, an average peak-to-trough decline near 19%. US Bank, Fidelity, BlackRock, the major research desks, all documented. It is among the most established seasonal patterns in all of markets. So if it is this well known, why does no warning come now? The answer is timing. The midterm drawdown is neither magic nor the calendar. It is uncertainty, political uncertainty, and markets fear uncertainty more than they fear bad news itself. Consider what a midterm decides: control of Congress, and with it, taxes, spending, regulation, trade, and whether the sitting president can accomplish anything at all for 2 more years. For most of the year, none of it is settled. Polls swing, narratives reverse, every outcome remains on the table. When the range of possible futures is wide, the market does what it always does. It demands a discount, it turns choppy, it sells first, and asks its questions after the votes are counted. That is why the weakness is almost always front-loaded, heaviest in the spring, the summer, the early autumn, before the vote. And here is the tell that uncertainty is the true engine. Since 1970, the market has, on average, rallied in the final month before a midterm, roughly 22 trading days out. The reason is simple. By then the polls have narrowed, the fog is lifting, and the instant it lifts, the buyers return. So the pattern is not, midterms are bad. It is this: fear peaks before the vote, and then it resolves. The dip is the fear, the recovery is the resolution. Which raises the question of 2026. If the midterm dip usually front-loads into spring and summer, where is it? Because by August 2026, the S&P 500 is up around 13.5% on the year, sitting near record highs. That is not what a textbook midterm year looks like at this point on the calendar. There are 2 honest ways to read it. The first, this cycle simply breaks the pattern. It happens. The dip is an average, not a law. Midterm year outcomes have ranged from a 27% drawdown all the way to a nearly 40% gain. Some midterm years are, in the end, fine. Perhaps the AI earnings boom powers straight through, and the pattern quietly fails to appear. That reading deserves fairness. But there is a second reading, and it is the more troubling one. The dip has not appeared yet, and the ground beneath this market is unusually fragile. Consider the layers. First, valuations are stretched. The S&P's forward price-to-earnings multiple sits around 21 to 22 times earnings. Historically, that figure runs closer to 15 to 18. A premium price leaves less cushion. The good news is already priced in. Second, concentration is extreme. The 3 largest companies, Nvidia, Apple, and Microsoft, make up roughly 20% of the entire index by themselves. 1/5 of the S&P is 3 stocks, and beneath the surface, breadth is thin. At points this year, only about 1 in 6 stocks was even keeping pace with the index over a trailing month, one of the weakest readings in a decade. When an index leans this heavily on so few names, it does not require a recession to fall. It requires only that those names wobble. A single disappointing AI earnings call, and the force that carried the market up begins to carry it down quickly. Third, the AI bet is enormous. The largest technology companies are projected to spend roughly $750 billion on AI infrastructure this year, up more than 80% from the year before. That spending is the engine of the earnings story and a vast wager that the returns arrive on schedule. Let doubt creep in for even a quarter, and those multiples can compress in a hurry. Fourth, the wider picture is not clean. Sticky inflation, an uncertain Federal Reserve, geopolitical risk humming in the background. None of it alone is a crash. All of it together is kindling. So here is the shape of it, a well-documented pattern that historically brings an 18 to 19% drawdown in exactly this year of the cycle, a drawdown that has not yet arrived, resting on an expensive, narrow market that leans its full weight on a handful of AI stocks, heading into an election that has not even begun to inject its uncertainty. That is the setup no one is warning about, not because it is hidden, because the screen is green, and green does not sell fear the way red does.
And this is where most of the warnings stop. They flash the frightening pattern, they shout the word crash, they say sell everything and buy gold, and they end. That is the wrong ending, because the very data that proves the dip is real also proves those warnings wrong. Return to that Stratogas study, 16 midterm cycles. Yes, the average drawdown was about 19%, but look at what came next. In the 12 months following the midterm low, the S&P 500 gained an average of roughly 31%. And here is the figure that ought to stop a person cold. That recovery occurred in all 16 cycles, every single one. 16 for 16, the market stood higher a year after the bottom. BlackRock found the same shape from the other direction, about 14% average gain in the 6 months after a midterm election, as the uncertainty clears. So the full pattern is not a horror story, it is a 2-act play. Act 1, fear builds toward the election, and the market takes a deep, frightening dip. Act 2, the fog lifts and the market historically climbs higher, often to new records, which means the midterm crash has again and again been one of the finest buying windows in the whole 4-year cycle. The drop was never the disaster. The drop was the discount. The disaster was investor behavior, and that is the real thing no one warns about. Put plainly, the market does not take an investor's money in a midterm year. The investor does by reacting to it. The sequence is almost a script. The dip begins slowly, then not slowly at all. The account is down 10%, then 15%. The headlines grow loud and apocalyptic. Every screen fills with red thumbnails and downward arrows. And somewhere near the point of maximum fear, which historically falls right before the election, right before the recovery, the ordinary investor breaks. They sell. The loss is locked in. Cash feels safe. And they wait for the all clear before returning. But the all clear never rings a bell. By the time it feels safe, the market has already staged that 31% recovery without them. They sold the bottom and bought back higher, the exact reverse of any sound plan, at the worst possible moment. And every step of it felt like wisdom, because fear always feels like wisdom in the moment. That is the trap. Not the drawdown, the reaction to it. The dip is shaped almost perfectly to shake people out just before the reward. So the task was never to predict the precise day of the low. No one can. The task is to decide what to do before fear decides for you. History rewards discipline, boring, durable discipline, and it points to a handful of lessons. The first, do not try to time it. Predictable on average is not predictable on the calendar. Outcomes have run from down 27% to up 40%. Go to cash now, and if the pattern fails to appear, the upside is missed, and the position is worse. Sitting out to dodge a dip that may never come is its own way to lose. The second, know the concentration. In an S&P or total market fund, roughly a fifth of the money sits in 3 AI mega caps. The honest question is simple. If those names had a rough quarter, how would the whole portfolio feel? If the answer is sick, then a measure of diversification beyond the mega caps, perhaps beyond the United States, perhaps into bonds, is best done before the volatility and not during it. The third, keep dry powder and commit to it in advance. If a real dip does come, that is historically where the best long-term entries are made, not the moment to flee. So the disciplined choice is decided in writing, in calm, ahead of time. What happens to spare cash if the S&P falls 15%? Perhaps added in 3 portions on the way down. The calm, rational plan gets to overrule the terrified one.
The fourth, rebalance on a schedule, not on emotion. A rule, quarterly, or whenever the allocation drifts more than 5%, forces the trimming of what has run and the buying of what has fallen, automatically, with no need for courage in the moment. The fifth, zoom out. Every one of those 16 cycles was terrifying at the low. Every one of them recovered. For money invested across years rather than months, a midterm dip is simply part of the terrain. It has never once been the end of the world. So, the account comes back to where it began. The pattern is real. Midterm years are the weakest of the cycle, carrying an average intra-year drawdown near 18 to 19%. And in 2026, that drawdown has not yet appeared, resting on a market that is expensive, narrow, and carried by a handful of AI stocks, moving toward an election that has not begun to throw its weight around. That is what the record highs quietly conceal. But the ending is not sell everything. The midterm dip has, throughout history, been a discount and not a disaster, and the only ones it truly harms are those who panic into it and sell the bottom moments before the recovery. The pattern is not destiny, it is a warning, one worth hearing now while the screen is still green.